Okay, today we are going to talk about, this is on page, what is it, 7? So I have this chart I put together that talks about the different factors that you'll analyze when you're deciding, which of these different formats you might want to use for your business. And we've got these different factors, including liability protection, how they're taxed, what formalities are required in terms of paperwork, financing, management, and other types of issues. So today I want to start with this first one, and that is liability, and the idea of whether or not the form of business structure that you're going to choose for your business provides for any level of liability protection in the event of something bad happening, like a lawsuit or a debt that cannot be paid, or some other type of claim against the company. So basically the way it works is here I've got unlimited under liability, and then over here on the opposite side we have limited. And what we're referring to there is whether or not the business structure forms a type of a shield, if you will, that protects against claims against the owners of the business personal property. Some of the business structures have a shield that will protect an owner in the event of a lawsuit or whatever. Others do not at all. So whenever I say unlimited, that means there's no protection. You as the owner have complete liability exposure. And then where I have limited, that means there is protection, and then in between there's sort of a combination of the two. So let me just kind of show you what I'm talking about here. So I'm going to start off with a general partnership. So a general partnership is essentially two or more people that are engaging in activity together with the intent to make money. That's the basic definition. A general partnership has no liability protection. Sole proprietorship, one person, legal business entity, without being organized, same thing, no protection. So this idea, this diagram is going to be kind of the same for both a sole proprietor or a general partnership. But we'll use a general partnership just for today. So let's say we have two partners in a general partnership, partner one and partner two. So each partner, let's say it's a farm operation, okay? So each partner has their own personal assets. So they may have a house, right? And they may have money in their own personal checking account. They may have an inheritance they got from their family, their retirement account, motor vehicles, basic assets that you have. They're your personal assets. They are not assets of the business. They're your own personal assets. So let's say each partner has their own personal assets. Let's say this partner is worth $500,000, including their house and other stuff. And let's say this partner over here has $1.1 million of personal assets. So they go into business together to do this farm or a construction or a restaurant type of a business. And so in the partnership, of course, they're going to have a checking account where they're going to put money that they gain from selling products and whatnot. Maybe they have land, equipment, inventory, and other type of assets. And of course, insurance. So these are business assets, and then up here we have their personal assets. So let's just assume that they have, $2 million overall worth of assets in the partnership. And then their personal assets are up here. So one day, one of their employees is driving a tractor or a combine or whatever, implement, going from one field to the next. You see it out here all the time. And while they're driving the tractor down the road, our employee runs over somebody on a bicycle and they're severely injured or killed. So we get sued now because our employee hurt somebody. So let's say it's a $5 million lawsuit, wrongful death lawsuit. So here's the problem. The employee was driving the company tractor from one field to the next, ran over the bicycle rider. We are liable for the actions of our employees, so we will be responsible for paying this lawsuit. So the way that would work in the real world is they win a $5 million lawsuit, so they're going to seize all of the business assets. Either through a garnishment, they'll go take the money out of the partnership checking account. The land will be sold at auction. If there's insurance money, it'll be paid out. But altogether, that's only worth $2 million. And we owe $5 million. So that leaves $3 million still left owing on the lawsuit. Oh, come on, focus, all right. So, because this is a partnership, there is no liability shield there. That means that both partners are equally liable, it's called joint and several liability, for paying any claims against the partnership, including out of their own personal assets. So now, there's insufficient business assets to pay that lawsuit, so they can go after the individual assets of the owners and seize their personal assets as well. There's no shield that protects them. So when I say unlimited liability, right here, that's what I'm referring to. There's no shield that is created. Both your investment in the company and your personal assets are what we call at risk. On the opposite end is when we start getting into liability protection. And that's one of the primary benefits of entering into one of these other forms, is to allow you some degree of protection of your non-business investments, your non-business assets such as your house and whatnot, or if you have other business interests, you don't want them maybe crossing over with each other. So there's another problem that we run into when we talk about a partnership, and that is individual liability of each partner. So here we had a lawsuit arising out of the business activity, but the other problem with the partnership is, let's say this partner goes out and does something wrong. Maybe they go to lunch, and while they're at lunch they drink a bunch of beer, and then on the way back to work they run over somebody. So they did something wrong. They're going to go to jail for driving under the influence and vehicular assault. But in a partnership, there's no liability protection this way either. So the other partner may be liable for the bad actions of the other partner that were in the course and scope of the business. And the problem there is, if you're an investor or whatever, you're putting money into a business, you don't want to have potentially exposure for the actions of your other owners, especially in something like a medical practice where you don't want to be liable for the other doctor's malpractice. You had nothing to do with it. That's really, the other doctor's responsibility. So not only do you want to have protection from claims coming this way, you also want to have protection here to separate liability among the partners so that you're not responsible for each other's things that you did wrong, like malpractice. So let's contrast now with the idea of a corporation or an LLC that provides full limited liability. When I say full, that's not exactly correct. There are ways around it. But some layer of liability protection. And then we'll talk about silent partnerships or limited partnerships later. So here's essentially how it would work, and I'm just going to use the example of a corporation or an LLC, because they're essentially treated the same to a degree. LLCs and corporations have more or less the same liability protections. In the real world, a C Corp actually probably has the most liability protection, but it gets pretty nuanced, and I don't want to go into it. So now let's say, again, we have owner one and owner number two in the corporation. And each one of them has their own personal assets. So again, let's say this owner has 500,000 and this owner has 1 million of personal assets. And same idea, we have 2 million of corporate assets, just like before. We get sued for 5 million, which leaves 3 million that is unpaid. So all the corporate assets will be taken just like before. If there's insurance, it'll pay off. But now, when they try to collect on this 3 million that's unpaid, there's going to be a barrier that is created by the corporation. It's going to act like a shield. And so all of the corporate assets, of course, will be taken. But when they try to go after the individual owners, there will be a shield there that will protect the owner's personal non-business assets from the corporate claims, including a lawsuit against the corporation, or it could be debt, like a lease or a loan. So there's a shield there that is created. In addition, there will be a shield this way that will insulate the owners, to a degree at least, from claims arising out of the other owner's bad actions. So when we talk about limitation of liability, that's what we're referring to. Is there a liability barrier that is created by setting up either a limited partnership, a limited liability partnership, or one of the corporations or an LLC that will help provide a barrier between your personal assets and your business investment, the business assets. And you see over here where we have limited liability, that's that full shield that I'm talking about right here. In between, we have limited partnerships and limited liability partnerships, and they're sort of a blend, and I'll diagram those out at a later time, where you have some liability protection, but it's not complete. Some of the partners have full liability, some have total liability protection, so there's sort of a blend there, which I don't want to go into that today, but we'll talk about it later. So what I want you to know for today, sole proprietor general partnership, there's no liability protection whatsoever. All of your personal assets are at risk, along with whatever value the business has. S Corp, C Corp, and LLC have the greatest degree of liability protection that is created by forming the entity, and then we have a blend in between. Now with that said, let's go over to page 6, where I have these factors sort of laid out a little bit. So limited liability. When we talk about limited liability, we're talking about using an entity to shield from debt, such as a loan, a lease, lawsuit claims, negligence of your employees or the other owners, or other type of lawsuits that are coming out of your business activity. For most part, however, taxes are not going to be part of the shield. So if you are responsible, you're the owner of the company, or you're the one in charge of doing, say, payroll, or otherwise filing taxes, you cannot hide behind the corporate shield and not pay taxes. Both federal and state law typically will provide that the principal owner will be personally liable, especially for payroll, tax withholdings, Social Security withholdings, Medicare, Medicaid tax. We'll talk about those later in the term. Also, if you have retirement accounts where you're putting money in that your employees are contributing, maybe you're matching that money as part of a 401k or something, you will still have personal liability. Even if you're a partnership, corporation or an LLC, you cannot escape that liability for those type of claims, for the most part. Now, I've also written down over here 3 other times when this shield that I'm talking about may not be effective to shield from personal liability. So the first one is what's called a personal guarantee, right here. Personal guarantee. And I apologize for my bad handwriting, it's just how it is. So let me explain. A personal guarantee is a very common thing, and especially in small business, but it's true in larger businesses as well. So this generally is going to relate to a contract. Typically it's going to be a loan of some type. So perhaps we have an LLC or a corporation and we want to go borrow money so we can buy a new tractor or a new combine or more equipment for our farm, or we want to buy fertilizer or fuel. Maybe we have an account, a revolving account for fuel with the oil company and the fertilizer company, and we may be getting $200,000 or $300,000 worth of fertilizer for our farm, and so that's on a form of a credit with the fertilizer company. So long story short is it's very common. This is also true in a lease, if you're leasing property for your office or your restaurant or whatever, that the landlord or the lender will require the owners of the business to sign a personal guarantee. And this is essentially a paragraph in the contract itself that says the owners agree that in the event of a default by your corporation or the LLC, that the owners will be personally liable for payment of that debt. It is standard practice in small business. If you work for a bank or you're extending credit, you should always ask for a personal guarantee from the owners. If you're a landlord and you're leasing property, you're going to want a personal guarantee, because if you don't get a personal guarantee, let's say the lease is in the name of the corporation. The corporation basically dissolves. You can't go after the owners for the rest of the lease because the corporation is the tenant. You're the landlord, and without a personal guarantee, you're stuck. You basically eat it. So this is also true in a situation where maybe you're providing supplies. Like, let's say you're a coffee roaster. You custom roast coffee, and you supply it to various different coffee carts around. I actually had this case once, that's why I said. So you're dropping off coffee every week to these different little shops that sell coffee, and then you give them a bill, they're supposed to pay within 30 days. That's a form of credit. It's called a net 30. And the idea there is you are extending credit by giving your customer, the coffee shack, basically 30 days to pay your bill. Well, what if they go bust? You want to get paid for what you're owed for the coffee that you delivered. Again, as part of your sales invoice, you should have a personal guarantee that the owner signs, because you're supplying them with credit, and that way you can go after them personally if they don't pay the bill. So a personal guarantee, standard practice for most lenders if they're lending money to a small business, especially if you're getting an SBA loan, Small Business Administration, they're going to ask for all the owners and sometimes their spouses to sign personal guarantees, like on your house, if you're both on the title. So that will be a way that this shield may be not fully effective. Now, a personal guarantee is unique and will only be applied to that specific debt. It doesn't mean that others that are not part of the personal guarantee contract can go through that shield. That shield will still be there for other type of claims. It's only for that one contractual debt. It has to be in writing and part of a contract to be effective. All right, there's another way that this shield may not be effective, and that is in a situation where essentially the owners are commingling assets with the corporation or the LLC. And this is called, you may have heard this term before if you've taken other business classes, piercing the corporate veil. You may have heard that term. And this is a phrase that refers to the ability of a judge in a lawsuit to declare that the shield is not valid as it relates to one or more of the owners. And this will typically be a situation where the owners are utilizing the corporate checking account, corporate credit card perhaps, or other corporate assets interchangeably with their own personal assets. And so, for example, maybe it's a farm and the owners are using the corporation to pay for their own personal bills, their dish network at home that has nothing to do with the farm. They're buying clothing, personal clothing, not farm clothing that they use. They're paying for vacations, other things like that. Or maybe the owners are using the corporate credit card for personal activity and they're not doing reimbursements. So in that kind of case, a judge can essentially say, okay, you are commingling your personal assets with the business assets, and therefore it's called a fraudulent transaction. A judge can declare that one or both or more owners are truly not keeping a separation between the corporate assets and activity and their personal assets and activity, and therefore a judge can have that shield basically dissolve. This would require proof on an ongoing basis of the failure to maintain separation between personal side and business side. And this is pretty common in the real world. I myself have done this myself, where I'll go to the store and I need to buy coffee for my business, and I'll pay for it myself with my own personal funds, or vice versa. Maybe I forgot my debit card, and so all I have is my corporate credit card, and so I'll buy a personal item on my corporate credit card. Real common. So in order to avoid that problem, you have to make sure you do good bookkeeping. You want to make sure that if you're using the corporate credit card or whatever, debit card, that you reimburse the corporation, the business, for your personal, or at the very minimum, declare it as part of what's called a distribution for your taxes, saying that this is considered to be a distribution of profits to you. Because otherwise, if you don't have that paper trail for reimbursement, it can be argued that you're commingling. And then this last one here, let me explain that. Personal action. Let me explain what I mean by that. So when we talk about this shield, we are talking about actions arising out of the business activity for which there will be a shield of personal liability. So I use the example of one of our employees driving a tractor and running somebody over. In that case, that shield will apply. However, what if it's one of the owners that was driving the tractor, and the owner ran over somebody? So let's say owner number one is the one that was driving the tractor. Now, the owner is acting as essentially an employee of the corporation. So the corporation's going to get sued, but the owner will also be sued individually because they were the one that was actually driving the tractor. And so you can set up whatever kind of corporation you want, but the point I am making is if you are the one that personally caused the injury, even if it's in the course and scope of your business, you will still have personal liability. So if you're driving the tractor, or in my case, I'm a lawyer, if I commit malpractice, or my wife's a dentist, she's also a corporation, she's the one who does something personally, you cannot escape, with some exceptions, but for the most part, you cannot escape personal liability for what you did wrong yourself. Does that make sense? Now the other owner will be protected because they didn't do anything wrong, but you're the one that was driving the tractor, therefore you will always have personal liability. Now how do you protect yourself? So this is something for your project I want you to discuss, both in part 1 and part 3. Number 1, to protect yourself from personal liability, you set up an LLC or an S Corp or a C Corp or one of the entities that allows for that shield. But that is not always going to be the best absolute method, because that shield only applies, you've been sued, you've been to court, so you've already expended a bunch of money going and fighting the lawsuit. So insurance is still always going to be your primary line of defense. We'll talk about various kinds of insurances later on in the term, but essentially what I'm getting at is you're still going to want to maintain the required insurance by law because you have to, and also you want to make sure that you get insurance that may not be required by law, but a sufficient amount of insurance to cover claims that may arise out of your business activity. That's called liability insurance. You also want to make sure you have insurance that covers claims from what your employees may do wrong. And we'll, like I said, we'll talk about different insurances later on. But insurance is always going to be your first line of defense. And then also, how do you protect yourself? You think about the problems that might occur ahead of time, and you do employee training. You take steps to manage that risk as best you can by thinking through the problems that could occur before they happen and trying to minimize that risk. That's what I want you to write about in part 3 of your assignment, is how are you going, think through what problems you might have in your business and what steps you're going to take to try to reduce the possibility of lawsuits, don't get overextended on debt, and that kind of thing. Okay, so that's what we mean by limited liability. So now let's talk about the next factor that we're going to review when we're deciding which of these structures to choose, and that is income tax. What we're talking about here is income tax at the business level. We're not talking about personal income tax or other type of taxes such as sales tax or excise tax or fuel tax. I'm talking about purely income tax. So you'll see here I've got single tax, and then we have double tax. And what I'm referring to is whether or not the business structure itself is responsible for paying tax upon its profits, or if the profits are going to flow through down to the owners, and then the owners pay tax on themselves, but not at the business level. So let me explain what I'm talking about here. We're primarily referring to whether or not you have to pay corporate tax or not. So double tax, single tax. So let's start off with a C corporation, because a C corporation is a taxable entity subject to corporate tax. Let me explain how this works. Right, so let's say we have a C corporation here. And for purposes of this class, I'm going to make it simple. Let's say we have one owner that owns 100% of the business. And again, let's say it's a farm, just for keep things. So let's say the farm has $1 million of gross income. 1 million of gross income. So they sell inventory and animals and grass seed or whatever they do in their farm. The farm has 900,000 of expense during the year, which leaves 100,000 of profit. Okay? So the C corporation is a taxable entity. So what that means is the C corporation has to file a corporate tax return, which is called an 1120 form. And assuming they're a calendar year taxpayer, they have to file that on March 15th. So that's a tax return. I have that form in our book. I'll show it to you later in more detail. So the idea is the corporation will file the tax return, report the income of $1 million, will report the expense of $900,000, and will report the $100,000 of profit. So the corporation will have to pay tax on that $100,000 of profit. So let's assume it's a 25% corporate tax rate. So that will be $25,000 in tax that the corporation will pay on its net income. So then That leaves $75,000 left over after payment of tax. After tax income. So the owner, the farmer, needs to pay their own personal bills. So they're going to take that money as a profit from their company. And then the farmer, on April 15th, will file their own 1040 tax form. And on that form, they're going to have to declare the $75,000 distribution that they received from their company on their personal tax return. And then they're also going to have to pay tax on that amount. Let's just say it's a 20% rate. So that'll be $15,000 in additional tax. So this is what I mean when I say I double tax on my chart. There's tax at the business level. And again, there'll be tax at the individual ownership level when those profits are paid out from the business. The owners will have to declare their share of the profits on their tax returns, and you'll have tax at both levels. So that's primarily going to be in a C corporation. The rest of the entities, I have single tax over here. That means those entities are what we call a pass-through entity. You may have heard that term before. I have that written out here, page 6. So a pass-through entity. Now what we mean by that is the entity itself is not subject to its tax on its profit. But the profits pass through out to the owners at the end of the year, and the owners then pay tax on the profits themselves when they file their individual tax return. So, classic example of a pass-through is an S-corp. As a pass-through entity, that's one of the reasons why S-corporations were created, to allow corporate structure without having to pay corporate tax. So again, let's say we have $1 million of gross income, 900 of expense, which leaves 100,000 of profit, just like before. So now, we have one owner here, just like before. Okay. So, $1 million gross income, 900,000 of expense, $100,000 profit. So on March 15th, the S corporation, even it's not subject to tax, but you still have to file a corporate tax return called an 1120-S form. And that form is intended to tell both the IRS at the federal level and the Oregon Department of Revenue at the state level how much income, expense, and profit there was. It's what we call an information tax return, and that's going to tell the government that they should expect to see this $100,000 of profit will pass through the business down to the owner. So the owner is going to have to pay tax on April 15th when they file their 1040 form. The owner is going to have to pay tax on all of that $100,000. So it passes through the business to the owner. And then the owner will pay tax whatever their individual rate is, so let's just say it's 30%. So $30,000 in tax. Okay, you guys with me? That's why we call this a pass-through entity. Partnerships are the same. To a degree, a sole proprietorship is the same. Most LLCs are going to be the same way. Those are all pass-through entities. So the idea is that income, or the net income, is still being taxed, but it's not being taxed at the business level, like in a C Corp, or example we just did, where it's taxed at the business level and again at the individual level when the profits are distributed. Instead, the profit flows through to the owners, and they pay tax at only one level, and that's at their individual level right here. So single tax, that's why we call that a pass-through. Now, this is very important. Why? So number one, you're paying less tax as the owner. You can avoid the tax. But part two to that is this pass-through occurs whether or not you actually take the cash out of the corporate checking account. Now let me explain what I mean by that. You've got $900,000 of expense for the year. So let's just assume that's, on a consistent monthly basis. What's that, about 80 grand? Not that much, but so you got about 75,000 of expense each month. So you need to leave enough money in the corporate checking account to be able to pay January's bills. Well, the problem is you have to pay tax on that whole 100,000 even if you leave it in the company checking account. So you may not actually have the cash, but on paper you do. So you have to plan for that. And this is where I see a lot of businesses have problems, be it an S-Corp, an LLC, or whatever. They don't plan for this idea that you're going to be taxed on all of that money even if you don't actually pull it out of the business. I've had a lot of clients just say, well, I'll leave it in the corporate account. Well, that's fine, you could do that, but you're still going to get taxed on it. So you have to make sure you plan accordingly, because you're going to have to pay tax even if you don't pull the money out. And that's a commonly misunderstood thing about pass-through entities. You can't leave, you can leave the money in there, but it's the same as it sitting in your own personal account. So I want you to understand this concept of a pass-through entity, which I have on page 6. So when I say pass-through entity, that's what I'm talking about. The profits flow through the business down to the owners, and they pay tax on the profit at their own personal tax rate. A non-PTE or a non-pass-through entity would be a C-Corp. That is subject to the tax at the business level and at the individual level. Now, with that said, on my chart, you'll notice single tax all the way across, including LLC. Those are all the pass-throughs. Corporate C-Corp is subject to the corporate tax and individual tax. So that's the one where we have double. Now, just for the real world, there are some times when an LLC may want to be taxed as a corporation. It's very rare, but there is the possibility of an LLC having to be subject to that double tax rate. One instance of that is when you're doing business outside the United States, maybe you're doing international sales. And a lot of countries don't recognize an LLC as being a pass-through. Most other countries indicate that an LLC is a form of like a corporation, a C-Corp. So you may be subject to an international type of tax if you're doing international sales or other type of transactions. And then part two, sometimes an LLC will want to retain money, cash, in the LLC account for research and development or to build up cash for future acquisition of properties or equipment or other assets. And you don't want to distribute that money out to the owners because then they'll have to pay tax on it even though they didn't get the cash. So you want to do what's called a retained earning. You can do that in a corporation. You can hold the money back. It's still taxable at the corporate level, but because you didn't distribute the money out, the taxpayer doesn't have to pay tax on it because they never got it. You can do the same thing in an LLC. It's pretty limited when you do that kind of thing, but I just want you to be aware of that because you may read, well, an LLC may have to pay corporate tax as well, and that's true, but it's very, very limited area. Most LLCs are going to take on the form, from a tax standpoint, of one of the other structures like an S-Corp or a sole proprietorship and be a pass-through. That's why you do LLCs. And I'll show you how LLCs work in more detail later on. Okay, so